Oh, yes, yes, yes. Good morning, ladies and gentlemen. It is Wednesday, December 15th. It is FOMC Day, the last Fed meeting of the year, and there's so much to say. Hello, I'm Kenny Polcari, your host of the party, and here's what you need to know. Yes, history does repeat itself. Get to know and understand the 1978-1979 wage price spiral inflation conditions. In this case, guess what? It's good to be a dinosaur because we remember what happened. Expect markets to churn into the 2 p.m. hour today when the show starts. The International Energy Administration is cutting demand for oil because of Omni, cutting demand expectations, right? While OPEC is increasing the outlook for demand, right? So it's a fight. And what are we having for dessert at your Christmas table? We're going to try the Butterscotch peanut clusters. They are simple to make, but once you make them, you won't stop eating them. Okay. Oh boy. Producer price index came in stronger than expected yesterday at 9.7% versus the expected 9.2%. Right, that we were prepared for. Now, it didn't come in with a 10 handle on it, which was the whisper number, but it's still running very hot. Increases came from every end of the spectrum, right? Producer prices are running at the highest since 1974. Companies have no problem raising prices while others have no problem telling you that they're going to continue to raise prices in the not-so-distant future, and stock sold off. And as you can imagine, it was the most expensive names that came under the knife. The NASDAQ losing more than 300 points by 1 p.m. Before rallying back a little bit. All the talking heads tried to explain it away. By the end of the day, the Dow lost 106 points. The S&Ps were down 35. The NASDAQ ended down 175. The Russell lost 21, and the transports gave back more than 200. Every sector in the red except for financials, the XLF, and consumer staples, the XLP, which rose by 0.6% and just under 0.1% respectively. The growth trade falling 1.2%, while the value trade lost just 0.1%, leaving the gap in performance now at just 8% versus last week's 15%. Value is up now 19% year to date, while the growth trade is up 28% year to date. So, ladies and gentlemen, let me introduce you to the new Fed Chair Jay Powell, the one that was just appointed to the second four-year term and one that now makes him essentially a lame duck, which means he's not beholden to anybody. Because by 2025, Jay's going to be 72, and he's going to have had enough of this. And while he could be appointed for a third term, my money says not happening. It's just a hunch. I'm going with my gut on this one. And you should too. In any event, let's just roll back the tape for 1 minute. All year long, we had Jay the Dove. Jay kept telling us how inflation wasn't an issue and how tapering would be slow and steady, and that any change in interest rates was going to be well thought out and well after the completion of the tapering, making it very clear that the two were mutually exclusive. It couldn't have been any clearer. You would have had to have been living in a cave to hear anything else, or not to hear that message that he kept reiterating every opportunity he got. And then the day before Thanksgiving, Joey comes out and announces he's reappointing Jay for another four-year term, sending Lizzie Warren and the far left into a tizzy, right, into a tailspin, because they did not support it at all, but I'm sure Joey must have given them something to keep them quiet. And it was only a couple of days post-Thanksgiving that the new Jay Powell emerged. Meet Jay Powell the Hawk. This one, suddenly a bit more direct, not nearly as gentle as he had been, taking to the stage and saying that the Fed had misdiagnosed the patient. Inflation is a much bigger problem than he expected. So it's no longer transitory. So they're going to have to reconsider monetary policy going forward, and that means almost consider it immediately. Not 6 months from now, but like next week at the meeting, which is today. Suddenly, we had St. Louis Fed President Jimmy B calling on the Fed to double up on taper and raise rates at the same time. That was the turning point. It was just as they do, right? They send somebody out to float the balloon, to see what the reaction is, to get people to start to talk about it, to get the market somewhat prepared for a significant change in policy. And then more Fed members started to join that group. They start talking about the need to quicken on both fronts and what appears to be putting pressure on the Fed chair. Meanwhile, they were all on the other side, 2 months ago. Now they're all on this side. And then Jay reveals that we never really understood what he meant when he told us inflation was transitory because we don't understand the word, apparently. So now he's dropping it in favor of being more aggressive. And so now the ball starts rolling. And then over the weekend, when I appeared on the Larry Kudlow radio show, which I told you on Monday, Larry suggested that the Fed would move on rates in January, which caused me to go, what? The market's not expecting that at all. And then today, or yesterday, Larry was on TV telling us that if the Fed were smart, they would withdraw all stimulus right now, and they would raise rates by 50 basis points now. No taper, no waiting. Do it now, because inflation is now taking us into the wage price spiral condition, which means as wages go up, companies have to raise prices to compensate for the high wages, which then causes the workers to demand even higher wages to pay for the higher prices. And it becomes a spiral. It never stops until it does. But by then it stops because it absolutely blows up. It's a whole nother conversation. And so history does repeat itself. And this is exactly what I've been afraid of. Now, for those of you who weren't around, let me explain this. And like I said, I've been saying this for months now, that I fear we're going back to the late 1970s style of inflation. The last time we had wage price spiral inflation was during the Carter administration, 1978, 1979. Which ultimately pushed the annual inflation rate to double digits, 14.76%, in fact, by April of 1980. The spiral ended when the Fed, controlled by Paul Volcker, raised rates to 21% by June of 1981 to slow the buying and the spending, which then plunged the economy into a full-blown recession. So for the generation of people that have only known zero interest rates since they've entered this business, or for investors that have not lived through anything but zero interest rates, think 2008 and beyond, get ready and strap yourself in, because you are about to be educated. So much for being a dinosaur. It's actually working to my advantage in this case. How's it working for you? This morning, U.S. futures are churning patiently, waiting for the 2:30 p.m. presser. What will the Fed reveal at 2 o'clock? And then how will Jay discuss it at 2:30? What will the market assume? What will the algos do? Because it is the algos that can spin this thing right out of control, right? In a heartbeat. At 6 a.m. this morning, Dow futures were up 20, S&Ps were flat, NASDAQ was down 30, and the Russell was up just about 1.5 or so, 2 points maybe. Today, like I said, is going to be all about the speculation over what Jay said versus what Jay meant. People will hear what they want. The interpretation is going to be up to that person's own experiences. And so as I pointed out, for those of us that have lived through the last wage price inflation spiral, we understand the implications. So here's a bit of advice for the younger set. Sit down. You haven't lived it. Just wait. If they, the Fed, mismanages this, it's going to get ugly. Just ask anyone in the baby boom generation. We have real life experience, not this metaverse experience. Because as we now know, nothing bad ever happens in the metaverse. So go stick your head in the sand and go live in the metaverse. In the end, history does have a way of repeating itself. Treasury yields this morning are hovering at 1.4%. And so many keep asking, well, how can that be? Why aren't rates higher? If this is the case, rates should be higher. Because the Fed is still buying treasuries. They are defending the position. But that's about to change. Just wait until they really pull back and are no longer the buyer of last resort. Watch what happens to the bids and then watch what happens to the yields. Because the bids will fade, there'll be a void in prices, sellers will sell bonds down and yields will explode. Oil under a bit of pressure this morning. The chatter's about how supply is now going to outpace demand in 2022, which is a complete turnaround from what we've been hearing. The International Energy Agency now telling us that they think the Omicron virus variant is going to dent demand for oil, all while OPEC is set to increase production, right? Now, this is IEA is direct contradiction to what OPEC is forecasting. In fact, OPEC raised the forecast for global demand for the first quarter of 2022 and then beyond. Again, I think the demand destruction headline is just another manufactured negative headline to try and push oil prices lower. I'm a buyer of oil here. I am not buying it. I still say it's 80 before 60. Now watch, $68.15 is the long-term trend line support. That's a key level to keep your eyes on. European markets are mixed this morning. Both the BOE and the ECB are due to announce new monetary policy decisions tomorrow as inflation and the Omicron infections are rising. What will they do? when they speak? Will they point to the Fed as a guide? Inflation is up 4.9% across the Eurozone, while some European economies are still in lockdown mode over Delta. And this is complicating the picture for Christine Lagarde, ECB president, and Andy Bailey, Bank of England governor. At 7 a.m., the markets across the Eurozone are mixed. From Spain is down 0.6%, while Germany was up 0.7%. The S&P closed at 46.34 last night and will most likely churn this morning as we move into the 2 p.m. hour. Expect lots of chatter from the talking heads about what to expect. What will he say? How will he say it? First, trendline supporters at 45.86 are down 1% from here. Intermediate supporters at 45.13 are down 2.5% from here. Now, if the markets welcome the news, then look for the algos to take it right back up very quickly to test the highs. My sense is that he's going to try to control the narrative today without making any definitive announcement other than doubling the taper. He will suggest that they need to move on rates sooner than expected without defining a date. That is, I believe, until early January. This way, he protects the 2021 gains, and then he starts 2022 with a clean slate. So what happens then is what happens, right? He doesn't want to see a sell-off in the last week and a half of the trading year. So what do I say? Stay the course. Build yourself in downside protection to blunt any losses that I think are coming in the new year. There's no reason to sell good stocks, especially if the thesis for why you own them continues to remain intact. Why are you selling Apple? Really? You're really going to sell your Apple? Remember, you can text the word invest at 21,000 on your cell phone to get my digital business card. Feel free to download it. Send me off an email or a text. I'm always happy to engage, and I'm always happy to talk about markets, planning, thoughts, concerns, ideas, whatever you got. Remember, you can also follow me on Twitter and TikTok at Kenny Polcari and on Instagram at KennyP1961. Okay, so now I'm back to the desserts for the Christmas Eve table. Or the Christmas table. You can do it any way you want. Or you have them at both nights. In any event, this is one of my favorites. This is my grandmother used to make these. They're simple to make. They're just butterscotch and peanut clusters. You don't even bake them. And I'm going to get, it's just simple. It's just simple, right? And like I said, it is a personal favorite of mine, right? I usually only make these around the holidays. So when I'm eating them, you know, Christmas is around the corner and Santa Claus is on his way. Right? And when I eat them, it brings me back just to an earlier time in my life, right? When I was younger and life was not nearly as complicated as it is. And today, this is something that I do with my girls, right? Every Christmas, we sit around, we make these, and it brings them back to their childhood as well. All right, so for this, you need the Nestle Butterscotch morsels. You need salted peanuts, and you need those Chinese noodles, you know, the crunchy ones like the noodles. You want to begin by setting up a double boiler. And when it's nice and hot and it's ready, you're going to add the butterscotch morsels to the double boiler. You want to stir them until they melt. And now you're going to add in those Chinese noodles and you're going to mix them around. They'll break, that's fine. And you're going to add in the salted peanuts. You're going to stir it to coat it well. You want everything covered in the butterscotch. When you're ready, you're going to remove the double boiler from the heat. And with a tablespoon, you're going to just take tablespoons of this mix of the peanuts and the butterscotch and the Chinese noodles, and you're going to plop them down on wax paper, right? So set out the wax paper on your table, and then you're going to take a scoop, you're going to plop it, and they're going to just form into like clusters, right? You don't push them around, you don't try to make them look like a cookie. They're just clumps of the Chinese noodle, the butterscotch, and the peanuts, and they form like little clusters. Put them on the wax paper, let them harden. Now you can put them in the fridge to let them harden faster. You can just leave them out. Because as they cool, the butterscotch will get hard again, and that holds everything together, right? And then you'll see how quick it happens, because they cool fairly quickly. And like I said, put them in the refrigerator, that's fine, to help them cool faster. In any event, once they're done, you pick one up and you pop it in your mouth and you eat it. Oh my God. You're just going to sit there, you're just going to keep eating them because they're that good. And like I said, for me, it reminds me of my grandmother, and it reminds me of being a kid. In any event, it is the holiday season coming upon us, right? So it is what it is. It's another beautiful day in South Florida, and it's going to be an exciting day here for the market. So until tomorrow, take good care.